Hello, this is James Anderson with SD Bullion. In this shortened holiday week, we saw yet another batch of historic economic data. Some 16 million U.S. workers have officially lost their jobs in the last 3 weeks of time. We are beginning to see major media outfits forced to acknowledge that we are on an unemployment trend which may meet that of the Great Depression, which officially peaked at 25%. Even the Federal Reserve's own economic blog glibly states, a potential of near 50 million U.S. workers may lose their jobs by the end of this June 2020. That would result in an unemployment rate of over 30%. Full employment is but one half of the private Federal Reserve's consistently failed mandate, and even before this viral crisis and economic shutdown began, the nation's labor force participation rate was already at low levels, not seen since the last time gold was threatening the fiat Federal Reserve note's credibility in the late 1970s Western-driven bullion bull market, some 4 decades ago. Here you can see the private Federal Reserve is again exponentially hockey-sticking their balance sheet. Updated yesterday to over $6 trillion and likely headed to 10 and beyond in the months and years to come. At this pace, the Fed will have doubled their balance sheet since the start of the September 2019 repo loan ramp, which we started covering from the beginning of these SD Bullion gold-silver market update videos late last year. We'll leave the entire playlist of our work thus far in the comments section below in case you missed some episodes along the way. The last time we saw a financial crisis of slower and shallower magnitude than we are seeing today, the QE program got announced by the Federal Reserve in late November 2008. Spot gold at the time was around $800 an ounce, while 1 ounce American Gold Eagles were selling then on average at around $1,000 a piece. Spot silver at the time was around $10 per ounce, yet 1 ounce American silver coins, if you could find them, were selling almost double the then silver spot. So with QE Unlimited now unleashed, one might wonder how our somewhat recent history might further rhyme in the future upcoming. In our last video, we dug into how the still gapped out price discovery between the over-the-counter spot gold price versus the COMEX gold futures price is now at near 50-year high levels, both nominally and in underlying percentage terms. Here's how the divergent gold spot versus gold futures market ended this week. Here too is how the divergent silver spot versus silver futures market ended this week. The LBMA effectively again used Reuters as a press release conduit. A snippet from their article yesterday reads, "Worries that it may be impossible to ship gold quickly from London, a major storage center, to New York, have pushed U.S. gold futures prices far above London spot levels. Dealers in bars and coins have also faced shortages, with demand for gold traditionally seen as a safe haven asset accelerating as the economic impact of the virus becomes clearer. Charter flights have now been approved by insurers in terms of shipping gold," LBMA CEO Ruth Crowell told a conference call with market participants, calling it a positive and significant development. Yet one only has to look at the last 20 years of UK to USA import-export data to realize that London gold exports to the USA are only a recent, last year 2019 into this year 2020 phenomenon. Meanwhile, this week, I'm getting messages from those who actively trade physical precious metals in the City of London that this divergence reflects that the COMEX is broken, not London. Judging by the latest unprecedented COMEX rules changes, the anonymous trader may be spot on, pun intended. With time unfolding and physical bullion demand perhaps escalating, the truth will become more obvious as to what we're witnessing here. Stand by in the weeks and months to come for more smoke to clear. Finally, some notes from respective macroeconomic and technical analysts who flat out called these recent strong downturns in the financial markets well-timed and in advance. They're often now using 1929 models, perhaps sped up, for where this current depression may go in terms of the nominal stock market and the general economy. While unlimited QE may still give stock bubble bulls or the return to normal crowd hope, our polite suggestion is that they consider what if they're wrong? What if an economic rebound doesn't come for years? Worse of all, the 1929 crash, which took decades, all the way until the 1960s Nifty 50 era valued in gold bullion terms, for the U.S. stock market to return to its 3-decade prior valuation level. And we're not saying a world war or that this economic and potential structural reset will take as long as it did back then. We could very quickly perhaps not only find ourselves with new inflationary jacked up stock market highs. What we are simply asking is, measured in gold, how long will it be until we return back to this median level right here? Why not consider a prudent gold and other bullion position if we are indeed to fall further down this slope for many years upcoming? Have a blessed weekend, you yourself, your family, and your loved ones out there.
If you enjoyed this content, be sure to give our video a thumbs up. If you're not subscribed to our channel, do that. And finally, be sure to hit the alert button so you don't miss these market updates as they come along. Give us your comments below. Let us know what topics you want to see more coverage on.